let's understand, why is it that Microsoft and Google and Facebook and Amazon, why did these companies become these behemoths that now everybody, what's funny? We did a radio show back in 2017, and there was an episode I called The Amazon Effect. And what I said was, because Amazon has become wildly profitable, this is going to become a blueprint, especially for retail investors, that they're going to sit there and say, oh, it's the next Amazon, right? This is a normal thing. And I said at the time that I thought that that impact was going to push valuations way higher than anybody thought. It was one of those episodes where I thought I had some good points. You look back on it and you're like, man, I didn't know how right I was, right? Yeah. That same type of thought process is being applied to AI, and it's a completely different animal. It's going to destroy as many tech companies as it builds. And just because they're not needed. So getting back to what I was saying, what made those companies, those tech behemoths, what made them so great? What made them so great is we were going into the information age and the internet, right? It's the software age. And through their first mover advantages and cash flow, they became home to the greatest coders in history, right? Which made their company more successful, which enabled them to hire more coders. And basically, they became the top paying code stations in the world, right? So if you were a coder or you wanted to be a coder or whatever, that's where you went. It's sort of like if we're having an IQ contest and we want to go find the smartest people, we're probably making a beeline to the Ivy League schools, University of Chicago, Cambridge, Oxford, right? Stuff like that, right? Because that's where those people go, because that's what typically enables them the greatest opportunities. The big tech companies are the same. Now what AI is doing effectively is putting that same power in everybody's hands.
It decentralized everything.
Totally.
Yeah.
Totally. And so everybody's jumping off this ledge, just saying, oh, it's going to be accretive. And you look at them and go, how? Who's buying it?
Yeah.
What is it replacing? That's the other thing. If it's going to be this successful, what of your products is it going to usurp? Right? Nobody's asking that.
No.
And so it's going to have as much creative destruction as it has creative. It's going to be unbelievable. In my opinion, the profit and revenue assumptions are I just don't think they're doing their homework. I'm like, guys, it's really hard to tell at this point, because what we know, the VC approach these guys are taking, the majority of these investments are going to be zeros. They know that too.
Yeah, but they have unlimited funds.
Right. Well, and so if I sound fired up, I'm fired up because I'm trying to inform people about this, right? I'm not anti the tech companies. If I'm a CEO of these guys, one of these companies, I'm doing the exact same thing. You have to, right? But you have to. I think the thing that people are missing, you have to, because it's as much of an existential threat to your business as it is an opportunity.
Yeah.
Right.
See, and the interesting thing is, when you think about it, while it's decentralizing a lot of things, at the same time, everybody started at Amazon level. So you're not getting a small contract up the street at Bob's Plumbing Shop. Your contracts are with the United States government. Everybody started at a point where they're so big, they're too big to fail. Everybody else coming behind will disrupt in the small markets, this, that, and the other. The people are going to make money. Their contracts they're contracts with the government. They're making stuff that blows stuff up and hunts people down. They're not freaking figuring out how to do, billing for an HVAC company.
Yeah. Now, what makes it tough in the short run is that, look, the AI winners, that's the other thing. We don't even really know what that looks like.
Yeah.
Right. And we're not going to for some time. Right. Like, just think of the way the internet has evolved. And you have to assume that AI is going to be that on steroids. And the reason why I say that on steroids is because it's not going to follow the normal growth arc that we're used to, because it's not operating with the same limitations of every other technology we've ever seen before, right? It's not, humans are no longer a limiting factor, right? So what it means is the rhythm of it and the expansion of it and the ways it branches out. If we thought the internet was the Wild West in terms of not understanding the way that this is going to ferret out,
Yeah.
we've got no clue
No.
with AI. Now, the difference is you could see, here was a very basic, simple thing that you knew the internet was going to unleash unbelievable amounts of economic activity and money. Okay.
Yeah.
It instantly allowed anybody in the world to sell their wares to anybody in the world.
Mhm.
Right. There's other things that it did, but that's all you need to understand. AI doesn't do that. The internet already exists. So we don't know. It's so much harder to predict what that looks like. Like I said, there's going to be as much I mean, look at a company like Salesforce, right? And we brought this up before. Look how big they are, right? What are they? I think 350, $400 billion company.
Yeah.
I mean, doesn't sound like a lot with Nvidia approaching 5 trillion, which is effectively, you're approaching 1/6 the entire size of the US economy with one corporation,
Yeah.
which is a scary thought all in and of itself, right? Like, meaning when a corporation reaches that size, it's no longer an American company. And that's one of the things that concerns you, right? It has as many going concerns outside of the US as it does inside. That's another discussion. But when you look at a company like Salesforce, you realize how many other look at a company like Roblox, right? Those companies will get beat by AI.
Yeah.
And all you have to do, you start an AI gaming platform, have the AI system make new games, undercut Roblox's price by 20, 50%. Right?
It's crazy.
Yeah,
Crazy.
CRM. If you want to take on Salesforce, you build an AI that builds CRMs, custom CRMs out for people, charge them half as much as Salesforce. Done.
That's so bizarre, man. It's a trip.
Yeah.
Talking to Zach Abraham, Chief Investment Officer, Board Capital. All right, now that we've got AI out of the way and the chaos and the craziness that could be the Wild West. What do you make of, again, the economy? I look at the Main Street, Wall Street are two separate things. It's never been more real than that. Like it used to be they were semi-connected. Now they're on the opposite ends of the world because people are feeling it in their pocketbooks, but they're looking and going, well, my 401k is going up. It's bizarre, man. And I think people are terrified that the slowdown is here. And they just, I saw this week, 22 states are in technically what would be a recession. And if California and New York went into one, the whole country would probably be one.
Yeah. This is the most complicated market with the most number of potential outcomes that we've ever seen. And people, when they hear me say that, are going to think it's hyperbolic. And it is absolutely not. And let me explain really quick what I mean. We've talked about the AI thing. What we haven't talked about yet are the second and third order effects off that, right? It is going to absolutely change energy industries.
Yeah.
It's going to change the way energy moves around the country. It's going to change the way natural resources are consumed and how they're kept. It's going to create fights over commodities like rare earth metals. And when I say fights, hopefully not wars, hopefully just economic battles, but history would suggest it's not going to play out that kindly. And then you look at markets, and they're so absurdly valued, especially here in the US. One of the concerns we have is everybody keeps going, how is the economy doing? And if the economy starts doing poorly, it's going to affect the stock market. I'm not convinced that's the case. The stock market isn't running on economic metrics anyway.
No.
Right. So I actually think the bigger fear to the economy is the stock market going down. So I think that you have completely unhitched the horse from the buggy. And I think the horse is pushing the buggy now. You flipped it around to where I think now what I would expect to see here, and let's keep an eye out. Let's keep an eye out in the last quarter of this year. I would actually expect, assuming this market rally holds, I would actually expect to see economic activity pick up in the last quarter of the year. People go, "Why, Zach? You think the economy's good?" I go, "No, the S&P's up 15%."
Yeah.
The biggest purchasing group and the people with the most money in the country are baby boomers, and they are living off of their 401ks and ETF portfolios, right? So, like I've said before, if grandma and grandpa have a $2 million portfolio and they're up 15%, that's 300 grand. Okay. If grandma and grandpa spent 100 grand and the portfolio is still up 200, is their propensity to spend this holiday on GI Joes and Barbie dolls for the kids, is it bigger or lower? Of course it's bigger, right? So I think that everything can keep rolling as long as the stock market keeps going up. The problem with that is the stock market is not going up for economic reasons. It's going up for money supply reasons, and it's going up for just fear and greed, right? Bubble type mentality stuff. So everybody's like, how do you know it's a bubble? Well, let me just tell you guys, you got the Fed funds rate at 3.25, and you've got the S&P trading at 32 times earnings. Okay. I know most of the people listening to this don't know how to run a discounted cash flow model, but just take my word for it. Those numbers don't work. They don't make any sense. Okay. They just don't. Then you factor in stock-based comp. You got to market realistically. If we comp it to historical norms, you're right up in that probably 40 to 42 times earnings. So you're right there at that techbubble.com level. What's the difference? The difference is a lot of the most bloated companies are at the top of the index. So when they tip over, the index doesn't have a bad run. The index gets smoked. You're looking at the NASDAQ right here. If the NASDAQ lost 70% of its value, it would still be trading at historically elevated levels. 70%. A 70% loss would not create a generational buying opportunity in the NASDAQ. It would take it down to a still elevated above historical levels. And the best proof of that, if people consider, Zach, what are you talking about? Okay, look at the second largest company in the S&P 500 and third largest. I believe Microsoft's a little bit bigger. But Apple, okay, and we've talked about this before, right? But Apple's long-term PE ratio going back to like 2005 to 2020, it oscillated back and forth between 17 times earnings on the low end to 22 times earnings on the high end. They were growing revenues at that time somewhere between 15 to 30% a year. You had fat margins. Fast forward to today, it's double that valuation, trading at 40 times earnings, growing at 6% a year with margins that have slid all the way down to 15%. Okay. So even by Apple's own metrics, if Apple lost 50% of its value right now, it would have the worst growth numbers of the last 20 years and would be at the high end of the valuation range of the last 20 years. If it lost 50%, right? So I remember guys talking about a crash 4 or 5 years ago. And I was sitting there looking at the indexes and I was like, look, this market could go down 20 or 30%. But bottom line, is the NASDAQ a little frothy? Sure. But it can't lose 70%. There's too much value there, right? You look at today, it absolutely, and I'm not saying it will. I'm not even saying I think it will. But when you're looking at a market that could shave off 60 or 70% and still be on the high side historically of overvalued, that's pretty nuts. And that's where we are.
That's where we are. Talking to Zach Abraham, Chief Investment Officer, Bulwark Capital. What are you expecting for the fourth quarter? Because, I still think, I tell everybody the tariff thing isn't over yet. I don't know what's going to happen with that. And, while I think maybe they may, the court may side with Trump, the truth is that's not over. People are looking and saying, well, I'm going to go spend some money. They're already talking about how much they're going to spend, and the predictions are out there. I don't know what to expect. Like you said, man, this is the weirdest, it could be, we could see a massive jump in growth in spending in the fourth quarter, or I wouldn't be surprised if we were down a little bit. I don't know.
Yeah. There's so many things that are clouding this historically, meaning consumers behave completely different than they did even 15, 25 years ago. Okay. Meaning the consumer has repeatedly shown their willingness to lever up and do incredibly financially irresponsible and dangerous things to keep up with the Joneses, more so than they ever have in the past. Right. You look at the number of Gen Zers and millennials dipping into their 401ks to buy new clothes and to afford rent, do all this kind of stuff. That's just one example. Um, you know, e-commerce has changed the way a lot of things. There's just so many. Anybody that has a really strong economic outlook in this environment. We have a joke around here, which is the only guy we don't trust is the guy who sounds the most certain, right? Just because it's such a black box. However, if I was to look at things that I think are potential hat tips, I saw one today that I think is a little bit concerning for several different reasons. Ferrari had a big earnings miss. Okay. And they forward guidance was down. The reason I think that that's a concern is, again, what we were talking about with the stock market. The rich, the middle class used to drive this economy. That is no longer the case. It's the rich. That's what's driving the economy. The rich is also who buys Ferraris. If the rich quit spending the way they're spending, we're in trouble. This economy is in trouble because middle class is tapped.
Yeah. I mean, we're a top heavy economy.
Oh, more so than we've ever been.
Yeah.
Right. And if you think about what's going on in our economy, meaning the wealth effect, right? The wealth continues to get more and more concentrated, more and more few hands. One of the troubles with that is that the wealthier you are, the less benefit that increased profits and increased money to you, right? So the less benefit you bring to the overall economy. And the reason why is the wealthier you are, the lower percentage of your income you're going to spend, right? So let's say I make $5 million a year, and all of a sudden this year, my pay jumps up 20%, and I'm making $6 million a year. That's probably not going to change my personal spending habits whatsoever, right? And so that's the other problem, is that the people that are winning the biggest in this economy are already people that are already rich, right? So when the market's going up, it isn't helping the middle class. The middle class owns almost no stock, right? So, all they're getting the experience of with these asset prices going up is just they've got to pay more for them.
Yeah.
Right. So, and at a certain point, and Chad, I think you're getting close. I think you're getting close from this thing running out of steam. The reason why I cited the Ferrari numbers, we cited how, the middle class by and large has been left on the side of the road for the vast majority of this run. We talked about the potential without question, the destructive part of AI's technology. There's so many vulnerabilities here. And then you look at input costs, pretty much whatever those input costs, whether they're energy, whether they're rare earth metals, whether those costs are going up. You have an economy and a market that requires increasing prices to continue going up. And I think you're really pressing the edge of the runway here. Meaning I don't think the consumer can keep pace with the way things are moving up. And if the consumer cannot keep pace with the way things keep moving up in price, what does that mean? That means that prices will have to fall. That means that will depress corporate earnings, and you get a recession. What does that look like? I don't know. I don't think it's going to be apocalyptic. Why do I say that? Because what's going to happen when we hit recession? They're going to print more money.
Yeah.
So,
well, especially this administration, they're not going to let,
No, well, look, to be fair to this
administration over the last umpteen, administrations, but Trump is not going to say, not on my watch.
No. And quite honestly, that's the other scary point. I think you've crossed over the Rubicon as far as that's not even an answer. That's not even an option anymore.
Yeah.
right? Austerity, doing the disciplined thing, taking that disciplined approach. It's not an option anymore.
We've
The
turned
pain,
the too big to fail banks into too big to fail economy.
yeah, too big to fail corporations, too big
Mhm.
to fall chip companies, too big to I mean, you name it, right? And we just keep doubling down on this strategy over and over and over and over. And it's not good. None
No.
of this is good. And yet at the same time, we've got to keep our foot on the pedal on the AI race because we can't afford to let the Chinas of the world pass us up.
No, I mean the AI thing it's fun for everybody to play around with and to be great, for all the neat things and may take your job. But the reality is the AI race has nothing to do with business anymore. It has all to do with war.
Yeah.
That's it. It has all to do with
Yep.
defense and war. Nothing
Yep.
else.
And that's the other thing. Is it an AI bubble here in the United States? Of course it is. Another easy way to tell. Hear me out, guys. There are a bunch of companies around the world. China has a bunch. South America has a bunch. Companies that have effectively copied the large US tech company models, right? And to become like JD.com, Alibaba, kind of Amazons of China, right? Mercado Libre, kind of an Amazon of South America, right? You've got these companies, foreign. Okay, their stocks have not reacted to any of this to anywhere close to the level of US tech. Okay, so AI is just going to be profit beneficial to US tech companies? How doesn't it cut that way in China? Well, why is Alibaba not trading at 25 times sales like US tech companies are? Right? In a lot of ways, I think you could make the argument that I'd much rather own Chinese tech here. You don't want to know why? It's a fraction of the price, and the Chinese government has already proven to be protectionist, meaning they're not going to let US tech run in there and destroy their tech companies.
Yeah.
Right? So they've got 1.1 billion people. You're saying AI is going to be this boom. Guys, AI doesn't care whether you speak Cantonese or English, right? Like how this does not apply to any tech companies outside the United States, I find hilarious. So, do I feel that comfortable owning Chinese stocks? No, there's things about them that concern me for a variety of reasons. I'll tell you this right now. I would much rather own Chinese tech than US tech right now.
Yeah.
Trading at a fraction of the price, and it's actually gonna make a lot of money off AI. The other thing is the Chinese government is stimulating like crazy right now. And I have never seen more vapid investment thinking than I see in this environment today. It's really amazing.
It's crazy. Talking to Zach Abraham, Chief Investment Officer, Bulwark Capital. People want to reach out to you because you're not vapid. What do they do?
We're not tough to find. BulwarkCapitalManagement.com, KnowYourRiskPodcast.com. Just search both of those on YouTube or Google or whatever the case may be. You can find me on Twitter at KYR Radio or at KYR Radio. Not tough to find. Just Google us, Bulwark Capital Management, Know Your Risk Podcast. You'll find us, no problem.
Right on, brother. Good doing it. We'll do it again next week.
All right. Sounds good, Chad. Take care.
Investment advisory services offered through Trek Financial LLC, an SEC-registered investment advisor. The opinions expressed in this program are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or on any specific security. Any references to performance of securities are thought to be materially accurate, and actual performance may differ. Investments involve risk and are not guaranteed. Past performance doesn't guarantee future results. Trek 24308.